Lovely. Lovely. So I'm just going to cover the part. This has cropped up quite a bit where Mary will go through the finer points and details of auto-enrollment itself. But one of the areas that's caused some confusion and we're getting a lot of queries on is coming from employers asking about where they have existing employer pensions or PRSAs in place for staff and what does that entail? Or they're having a conversation with us and asking, well, if I have a pension in place, what do I still have to do auto enrollment or how am I fixed with that? So I'm just going to go through the reasons why we have a lot of employers making that query and are looking at setting up, if they haven't already, arrangements for staff instead of doing auto enrollment, instead of doing the compulsory piece that's required under auto enrollment. So as part of the auto-enrolment piece, existing employer pension plans, what the legislation states is that at present, an employee who has membership of an occupational pension scheme or an employer personal retirement savings account with any level of employer contribution will not be automatically enrolled in the auto-enrolment system. So if there is an occupation pension or employer PRSA, and there's a deduction showing on the wage slip for that. That's the look through that the body that's looking after auto enrolment called NERSA will use. Mary will touch on their role later on. But they basically have a look back. They're using revenue to get a look back at pay slips to see is there an existing occupation pension or an existing payroll PRSA contribution being made by the employer employee. Is that shown on the pay slip? And if it is, no requirement for auto enrollment, it's automatically excluded from it. So the questions then that employers and that we're having with employers and that is, first off, we're getting this conversation where we're asking employers, well, what's your opinion of pension provision for staff? We're seeing many that are sort of auto enrollment as being like a wake up call for them. And they're looking at auto enrollment and thinking, well, actually, we've been meaning to do something for some or all of our staff. And this is a reminder that maybe we should start looking at it now. So that leads to conversations then that we would have with them around the nature of their workforce. What sort of numbers do they have that qualify for auto enrollment? What's the salary like? What's the turnover like? What's the budget going to be for auto enrollment? And just sort of looking at that general information. The key to that information is in the next few questions. So one of the key areas is that if you have any employees that are paying income tax of 40%, that's a question we're asking employers, and I'll touch on the reasons why in the next couple of slides. We're also asking about if you have any employees who would like to save more for retirement. Now, that's a harder question for employers to know the answer to. Some employees may have come to their employers saying, do you have pension provision? Can you do it, etc. Those type of questions could have come at them in the past. Certainly the employer will have the detail around the income tax situation at 40%, but that second question might be a bit tougher for them to answer. Do you have employees that would like to retire before the state pension age? Again, I'll touch on why. And then employees with longer term service, and that's an interesting one as well that we'll cover off as part of it. So the 40% income tax, in essence, the government top up to the auto enrolment scheme is the equivalent of a 25% tax relief for the employee. There's no tax relief within auto enrolment. Instead, the government contributes a third of what the employee contributes. So that's the equivalent of a 25% tax relief. Now, the conversation we're having with employers is that you have this compulsory cost. It doesn't make any difference to you whether it goes into auto enrolment or it goes into an occupational pension, but it can make a difference to the employee. And those at 40% is a classic example of that. Because if I'm paying income tax of 40% and I'm not getting tax relief on the contributions I'm making under auto enrolment, I'm losing out on that 40% relief. Whereas if the employer sets up an occupational pension instead, and I make my contributions that way, then I am accessing that relief, and that's worth 15% more to me. So employers might find that they might opt for auto enrollment, but they might get a tap on the shoulder from one or two employees that are at that 40% saying, can you do it the other way for me, please? Because it would be much better for me and it's no difference to yourself. So that's a key area. Employees who want to save more or retire early, the key part to this is that auto enrollment has no flexibility. There's nothing there built in at the moment. The retirement age is fixed at the state pension age of 66. So, for example, if you have an employee who wants to finish work at 62 and access their pension funds, if it's in auto enrollment, they won't be able to. If it was in an occupational pension scheme, they could access it. Contributions cannot be increased by the employee under auto enrollment. So it's set at 1.5% at the start, will rise to 6% over the 10 years. But if an employee feels, actually, this is an opportunity now for me to catch up on saving that I haven't done in the past, can I contribute more? The answer is no through auto enrollment. You would have to do that outside of it. Whereas within an occupational pension, you can determine your additional voluntary contributions that you want to make. And then I mentioned the long-term service. So typically when we talk to employees in situations where the employer is considering a pension, we might get the situation where the employee feels, actually, it's too late for me. I'm at that age now. I didn't do anything in the past, and I'm probably gone past the time now where it makes any sense to do it now. But what I want to do here is give an example of somebody, age 52, working in a company for the last 7 years. And for the purpose of the example here, this employee has a salary of 40,000 per annum. I'm going to assume that the normal auto enrolment standard contributions over the next few years happen. I've got inflation running at 2%, and I've got an investment growth rate on those auto enrolment funds at 4% per annum net. So we're running up to age 66, the state pension age. And if I ran those numbers that way, what I'll find is that I'll have an estimated fund of about 78,000 at that point. Because of inflation at 2%, the 40,000 salary goes up to 51,000. And why that becomes important is this, is that under an occupational pension, if you've got 20 years service or more, you can access your pension fund through a lump sum of up to 1.5 times your final salary. So typically pension funds, 25% of the pot is the tax-free lump sum. But for occupational pension, you have this additional option where if it works better for you, at 1.5 times final salary can be your lump sum. And in this particular example, if I have my final pot of 78,800, under auto enrolment, I've got to take 25%. That's the maximum. So I'm getting 19,000 of that as a tax-free lump sum. The balance will be subject to income tax as I take it. Whereas with an occupational pension, that same pot, I can more or less take all of it as a tax-free lump sum. So I've got this long-term service employee, maybe a little older, in their mid-50s, coming towards the end of their working life as such, feeling maybe that they shouldn't be involved in, or it doesn't make sense to be involved in, but actually structuring it for them under an occupational pension can allow them to take all their funds back tax-free from the pension pot rather than just a quarter of it. And then there's a consideration as well for employers. So under an occupational pension, there's what's called a vested period. And this refers to the minimum length of time that an employee must be a member of the scheme before they become entitled to receive pension benefits from it. There's no vested period with auto enrolment. If you have an employee starts with you on the 1st of January, you include them in auto enrolment. If they leave 3 months later, any contributions you made into auto enrolment as the employer go with them. If you have an occupational pension scheme, you can have a vested period of up to 2 years. So you could have it at 6 months, maybe for probation, getting people past that. You might have it for a year, but maximum is 2 years. And in essence, if the employee leaves the scheme before they complete the vested period, they're entitled only to a refund of their own contributions minus the tax, their own income tax. The employer contributions are refunded to the employer. So that's a consideration that we've seen for a number of employers that may have a transient workforce who see pension as an occupational pension as an opportunity to reward longer term service. And Those that stay with longer will have the benefit of the occupational pension then and the contributions made by the employer. It brings an element of protection as well for the employer on cost that if people have left, that those contributions are coming back with them. So that's certainly a consideration for employers when they're looking at alternative options to auto enrolment. So when we look at the two side by side, Mary will cover off the eligibility. Employees aged between 23 and 60 and earning over 20,000 from all employments are eligible and are automatically enrolled. Contribution rates start at 1.5%. Vested period, there's none for auto enrolment, no AVCs, no single premiums, there's no tax relief. There is the additional government contribution. Retirement age is at state pension age, and they estimate that charges will be at about 0.5% per annum. That's what they're looking to cap it at. A company pension, the employee is not included in a company pension scheme where, if you're not in that, you'll be automatically included in auto enrolment, but otherwise the employer sets the eligibility. Contribution rates, employer sets that as well. Maximum 2 years vested period. AVCs, single premiums, all allowed. Tax relief is there as well to give some relief for employees and their contributions, particularly those at 40%. Retirement age can be between 60 and 70 for an occupational pension, so it's not just fixed at the age 66 state pension age. And in fact, with an occupational pension, if you have left that employment, people can access pension funds, their older occupational pension funds from age 50 onwards. So, and again, we've seen that from time to time, but under auto enrolment, not going to be available to you. And then charges typically be agreed between the employer and trustee. So, look, that's the sort of side-by-side differences between the two structures. The considerations then for employers, auto enrolment means you're going to have to contribute. It's compulsory. It's coming in on the 1st of January 2026. Make sure you've budgeted for it. You need to budget for the cost that's coming through, but also be wary and conscious of the future budgeting costs because that 1.5% contribution is looking to increase, as you know, up to 6%. A lot of employers want design oversight, though. A lot of them are talking to us about, well, can we put a structure in place for staff that are with us for 5 years or more? Can we make sure that we include senior management? Can we make sure we include people who are with us for 2 years or whatever it might be? But they want that control over who they have included in an occupational pension. They want that flexibility to tailor that scheme. And then they're using it to retain, should I say, and attract valuable employees. So it's very much being used as well. Yeah, auto enrollment is the minimum 1.5%. We can do differently. We will do more, and we're seeing contribution levels of 3, 4, 5, 6% coming through from employers then that are doing that for their employees rather than going with the basic auto enrollment route. So look, the actions then we're saying to employers is figure out what's the best option for your business. What's best for the business, for the budgeting, your future plans? What's best for employees? If you have employees with longer service, if you have those on 40% income tax, you've got to make a contribution. Maybe it's better you put that contribution into an occupational pension for them instead and giving them better options and better benefits through that scheme. If you have existing arrangements, review those to make sure that they will be included so that if you don't want auto enrolment kicking in because you're already making the arrangement, make sure you have the proper payroll deduction facility in place and it's showing in the pay slip. And make sure, obviously, you've got that payroll deduction capacity then to deal with that. And what we're seeing from all of that is then that the results are like, I get employers asking, so what are others doing? And it's a mix of everything. Some are continuing on with auto enrolment. Some are setting up occupational PRSAs or master trusts for individual members of staff. Some are setting up a group pension scheme to capture all staff and making sure there's AVC or AVC, additional voluntary contributions or AVC PRSAs available as well. And in some cases, is a mix of auto enrolment and some of those options as well. But as I said, the key part is what's best for the business, what's best for the employees. Make sure to check on that. So that's me for the moment, James. Thanks for that.